Good morning, good afternoon, good evening, wherever you're located on planet Earth. It's time for the PulseWave Report with yours truly, Dex the Algo Capitalist, aka the Vulcan, coming to you live from PulseWaveTrading.com, home of the world famous PulseWave Price Trigger Reports. So, here we are Tuesday, one day before FOMC Day, which is upon us. Tomorrow, which will be Wednesday. So we have quiet markets ahead of tomorrow's FOMC. Not too much going on. No major movements. If you count Bitcoin, kind of pulling back a little bit. Nothing too spectacular, but that's pretty much it. So yesterday we talked about the unintended consequences of the stimulus package. And we picked apart the language that was used and how they blatantly stated that this was going to cut poverty. And we discussed at length in detail how that is a farce and that is not going to have the intended result that they're looking for. It's sort of like when Reddit was in the news, everyone was talking about GameStop, blah, blah, blah. And then after that kind of died down a little bit, they said, now the next thing they're going to attack is silver. And when they said that, silver only moved $3. That was it. Moved $3 and then fell right back down to where it was before the talk. So it did not have the same effect that it did. And the reason for that is because they claim that the Redditors were using the Robinhood app. And Robinhood app does not allow you to trade futures. You can trade crypto, you can trade stocks, ETFs, but no futures. So you would have thought that if anything, you would have saw a disconnect or a divergence between your ETFs like GLD and SLV versus gold and silver futures contracts. But that didn't happen either. Instead, SLV and GLD are pretty much exactly where they were before the announcement. So as you can see here, it was just a bunch of talk. People wished that the futures would get up and go, but they're not. And we know why that is. For years, for decades, the gold and silver markets have been manipulated to be the way that they are today. Another issue that we have is that the COVID lockdowns, what they really did when you break it all down is that they accelerated and exposed economic weakness where most people did not see or know or hear about. The majority of people don't listen to talk radio, don't really listen to information or educational podcasts. They usually listen to foolishness, celebrity gossip, things of that nature. And because the Federal Reserve has been stimulating the U.S. economy for decades now, people are beginning to think that that is going to be a permanent situation. Just like the post-COVID situation, we're told and led to believe that it too will be a permanent situation, a permanent fixture, and we need to get used to it. That's what we're being told. Okay. But it's time now that we start looking at the unintended consequences of not only the lockdowns, but also of the stimulus on top of the lockdowns. It's sort of like taking a person who presents to the ER with a broken arm. And you say, hey, you come to the right place. We're going to fix this broken arm. It's not a problem. We see these all the time. Here's what we're going to do. We're going to go ahead and set it, put a cast on it, and then you're going to come back when it heals. And then we're going to break your arm again in the same place and put another cast on it. That's what we're going to do. And we're going to keep doing this because you have a broken arm and we have to fix that broken arm. Well, that's what they're doing. That's what stimulus does. It isn't a fix. It is temporary. Like putting a Band-Aid on a machete slice. If someone chops you in the arm with a machete, and you say, oh, that's nothing. Here, put a Band-Aid on it. You're not fixing and you're not dealing with the issue, you're not dealing with the problem. Even if you did emergency first aid, the person still is going to require stitches or surgery or something. And you doing the battlefield type medic duties until the person can get to a hospital, it's just a temporary fix. But you cannot lean on the temporary fix to be permanent. Without medical care, the patient is in trouble. And that's what we've been seeing here with this whole stimulus situation. You're just putting Band-Aids on a gaping wound. And then when you lock down, that is sort of the death knell. That is the last straw. It's like taking someone who is in the ICU and they are on life support. The machine is breathing for them and keeping them alive. And then there's a blackout, a power outage. And your backup generator does not work. That electricity loss is going to put the patient right over the edge. They're going to die. Without that machine, they're going to die. And that's kind of what the U.S. economy is on. The U.S. economy is the patient on life support. And the lockdowns are the power outage. And that's the thing that puts the patient over the edge. It's bad enough that the machine was breathing for the patient and keeping them alive. But then you cut the power. How is a patient supposed to survive? That's why they're keeping the lights on for now and letting the machine continue to breathe for the patient. They said we can keep this going forever. Even though the patient has no brain activity, and for all intents medical purposes, the patient is already dead. You're going to keep them on this machine for the family's sake, just so the family can feel better and feel like they're still alive and with them, even though they're not. So what the power outage does is it forces the family to face reality. This is the truth of the matter. The patient is gone. And that's where the U.S. is right now. Economically, the U.S. is gone. But people are still in the stage of denial regarding this. Why is that? Well, there are certain realities in play. that we need to look at. Now, there's an economist named Louis Alexander, all right? And he put out a piece, a report titled Turbocharged Global Reflation. Now, this is a very interesting read because in addition to vaccines and policy stimulus, an economic recovery synchronized across regions will add further impetus to global reflation. Now, what follows is a comprehensive and mercifully succinct summary of Alexander's views covering every global region and justifying why Nomura believes a tidal wave of inflation is about to be unleashed on the entire world, starting with the United States. The Democratic control in Washington means more fiscal stimulus, but partisanship and narrow majorities will likely constrain this policy. The pandemic will weigh on short-term activity, but the vaccine outlook is positive for the medium term. They expect constant Fed asset purchases through 2021 before a gradual taper in 2022, but risk skew towards earlier action, meaning that they believe that the Fed will begin this process a lot sooner. The Fed will likely stay at the ELB at least through the second quarter of 2023, with inflation remaining the key determinant to liftoff. The unemployment rate will decline more gradually from here as the pace of recovery slows relative to the post-lockdown rebound. COVID-19's impact on service prices and the impact of labor market slack, particularly on rent, will weigh on core inflation. Notable risks include new SARS-CoV-2 variants, along with both upside and downside risk around fiscal policy. Now that, ladies and gentlemen, is just the U.S. We haven't even gotten on the boat to sail across the ocean yet, but we're about to right now. Here we go. Europe. With lockdown still in place, we see the euro area GDP falling at a similar pace to the fourth quarter and the first quarter, then recovering in the second quarter. While underlying inflation remains low, base effects and policy changes should raise headline inflation sharply this year, not next year, this year. With GDP rebounding and inflation rising in the short term, we expect the ECB to keep policy on hold throughout the year. UK lockdown should have a smaller effect on GDP than last spring. A full recovery in GDP takes until beyond 2022. While pent-up demand and policy stimulus should be supportive, we expect a renewed fall in GDP in the current quarter. After another 150 billion euros of QE, we think the BOE is done with easing. We do not expect negative rates, but risk for negative rates still remain. How about Japan, the land of the rising sun? Well, as the government declared another state of emergency, real GDP growth in Q1 2021 should be negative again. With the prolonged pandemic rushing and pushing down inflation, suspension of the Go-To Travel campaign will technically increase the rate. We do not expect the the Suga cabinet to make any significant change in economic policy and in BOJ's monetary policy. Thus, the risk is renewed. So the risk is renewed yen appreciation caused by depending U.S.-China tensions and further risk-averse moves in markets. But then we got Asia. Asia's growth cycle appears to be headed higher, led by exports and investment, but private consumption should join in H2 2021. Vaccinations, faster global growth, the tech upcycle, and lagged effects of easier financial conditions should support the recovery. Positive growth surprise likely in China, India, Singapore, Korea, and Taiwan, but Thailand, Malaysia, and the Philippines likely to disappoint. Higher inflation is likely on base effects, the end of government subsidies, higher commodity prices, and a narrowing output gap. Policy rates will likely be left unchanged this year, but hikes are likely in China, India, Indonesia, Malaysia, and the Philippines next year. As far as China, we expect the growth recovery and Beijing's gradual policy normalization to resume following containment of COVID-19. In Korea, we expect Korea's sequential growth momentum to improve in Q1 on stronger than expected export growth. In India, economic normalization amid target inflation suggests rates on hold and a gradual withdrawal of excess liquidity. Indonesia, rising inflation amid debt monetization and current account deficits could test monetary policy credibility. And last but not least, the land down under, looking at Australia. The stronger than expected rebound continues, though central bank guidance for now remains dovish. So basically, in a nutshell, they're pretty much expecting things to fall apart. All right. And this is just how it is, ladies and gentlemen. And I have to tell you, the bond's still looking super weak. Super weak. And of course, the uber precious metal bulls are still calling for silver to explode forthwith. I don't see it. Could it move higher? Yeah. But as far as the algo charts go, silver is still in the Kumo cloud. All right. Still in the cloud, baby. And so far this morning, it's looking like it could pull back even more. Just saying. Look, don't shoot the messenger. I'm just here to tell you what it is, tell you what's going on. That's all I'm here to do, man. Don't get mad at me. I'm not the one that, is manipulating the precious metals markets. So this is concerning, to say the least, ladies and gentlemen. We're talking about turbocharged global inflation. It should be noted that this morning we do have beans in the teens. That's right, soybeans are at 14, 18 and a half. That's right, $14.18 a bushel. Yeah, that's a lot. That's more than 3 times. That's more than a 300% increase since, I want to say, 2000. So beans have gone. I want you to hear me clearly. The price of soybeans has more than tripled today in the last 20 years. More than tripled. The price of soybeans has more than tripled in the last 20 years, the last 2 decades. That's over a 300% price increase. How do you explain that? How do you account for that? That's something to think about. So that makes people a little bit concerned about where are we going from here. You can't talk about inflation without talking about these interest rates. Bond prices and the bond futures market have been just collapsing, plummeting, falling falling and it can't get up. So the concern is the Fed about to blow up the bond market? We just finished discussing that inflation expectations continue to soar, ladies and gentlemen. I just broke it down for you. I took you by the hand and I walked you around the globe. And I gave you what the global expectations were based on each country, each continent, each jurisdiction. We need to deal with this. Now, the U.S. 5-year break-even rate just hit 2.6%. So you got to start asking some questions. Now, remember, the Fed believes inflation won't hit even 2% for at least 3 more years. But the 5-year break-even rate just hit 2.6%. And then there's the yield on the 10-year U.S. Treasury, which is about to break its multi-decade downtrend, the second time since 1982. Yeah, remember when the interest rates were in the 20s for good credit if you wanted to buy a house? By the way, the first break occurred when the Fed attempted to normalize monetary policy by raising rates and shrinking its balance sheet. This breakout is occurring while interest rates are at 0. And the Fed is running a $125 billion per month QE program. Let those numbers sink in for a minute. Those who believe that all this money printing and subsequent inflation will unleash havoc, I just got to tell you, man, got to wake up to reality. We talked about this yesterday. Reality, there's fiction and then there's nonfiction. There's reality and then there's fantasy. We live in reality. If you want fantasy, go play Dungeons and Dragons. Go play Diablo 3. You know, go play Torchlight 2. All right? Because this is reality. Those games are incredibly fun, but this is reality. Now, stocks actually love inflation at first, but that love quickly turns to hate. Now, during the last bout of hot inflation in the 1970s, stocks initially bubbled up before crashing nearly 50% in the span of 2 years, wiping out all of their initial gains and then some. History repeats itself, ladies and gentlemen. This is a warning. This is a public service announcement. Inflation is going to annihilate investors' portfolios. Those who are properly prepared, however, will make literal fortunes. If you are a subscriber to the PulseWave reports, you ain't got nothing to worry about. On that note, if you're worried about weathering a potential market crash, you definitely need the PulseWave reports. Ladies and gentlemen, this is not a game. The Fed is concerned, and rightfully so. The smart money is concerned, and rightfully so. What is the plan here? How are they going to stave off hyper global inflation? How are they going to fix the deceased patient on the table? So back in the news is the big debate. Are we going to really see hyperinflation or are we going to see deflation? I don't know. But by the measure of the money supply, there was a 52% increase between February of 2020 and January this year. And that's just to start things off. Proof of the coming hyperinflation is all around us. It took centuries to get to $3.4 trillion in monetary base. and less than a year to increase it by over half. QED. This is all you need to know. At least you can't say you didn't know, that you weren't at least alerted to the potential iceberg in front of the Titanic. On the other side, the hacks and apologists for the central bank and deficit spending argue there is nothing wrong with the current monetary and fiscal policies. Paul Krugman in this debate asserts, in between many weasel words, that the Biden $1.9 trillion spending package won't cause much inflation. A Bank of America survey seems to confirm this finding, that 64% of people plan to pay off debt, save, or invest their $1,400 checks. Yeah, they're going to invest their $1,400 stimulus checks. If they were such savvy and shrewd investors, they wouldn't be needing and depending on the stimulus checks, right? Now, the rich are not going to receive anything. So this response is showing the middle class is not planning on living large with this largesse. One ugly fact is that the price of oil has shot up to the target price I told you of $65 a barrel. And the twin to inflation is rising interest rates. So when you have rising energy costs and then you have a rising interest rates, you got a problem. Now, the 10-year Treasury yield has spiked up to 1.6%. Do these data points not argue for accelerating inflation? At the same time, most car commercials advertise 0% interest rates for 5 or 6 year loans. This is not only a data point for lower interest rates, what would be the treasurer have to for consumer credit to be zero? Well, also for soft prices, it's going to make it very impossible to do. Now, the price of the car may not be discounted that much, but zero interest is a subsidy worth an additional thousands of dollars per car. So, as we dig in, Krugman argues that giving unemployed people free money is not stimulative. By the implication of his economic theory, this means non-inflationary. His reason is that it is simply replacing the income that people would have gotten if they had been employed, and therefore it is not giving them additional purchasing power. The fallacy is this is so ridiculous that we expect a 8th grader could see right through this. When those people were working, they were producing goods and services. Now they're paid the same, but producing nothing. That is, welfare checks prop up demand, but lockdown cuts down supply. If supply falls, but demand remains the same, we would expect what? Higher prices. We see it in certain goods. The consumer price index has perked up these last few months. But if you compare that going back to March of 2020, you'll see year-on-year changes in the CPI. Now, the data is through last month. The inflation number has not gotten out of range despite the breathtaking increase in the monetary base. Any argument for extreme inflation will have to say, in essence, yes, but it's coming. Is it? Well, before we get to that, let's take a look at the other side of the coin. Another thing we often hear, especially in the alternative investment community, is that the official CPI measurement is a lie. But it's not a lie. It's something else. Some debate what goods ought to be in the basket measured by CPI and what product ought to replace one that becomes obsolete, such as buggy whips. These quibbles are the inevitable result of the fundamental confusion built in to the nature of the index itself. The CPI violates a law of arithmetic that we all learned in 4th grade, which is You cannot add apples to oranges. The CPI does not only add them, it averages them. An average of two numbers is A plus B divided by 2. So, of course, there will never be an argument on which goods are included or the proper weighting, and therefore on what the right number for inflation actually is. But one thing should be clear. You could not obscure a massive drop in the value of a dollar just by switching one consumer good for another in the CPI basket of goods. And as you always heard me say on this channel, food and energy. Food and energy is the litmus test for anything that has to do with personal spending. Sorry, it just is. This is reality. This is reality. If you can't afford food and energy, you're done. All the other stuff doesn't matter. Everything revolves around food and energy. Food and energy is your sun. Everything else is your little planets. All right, that's the financial solar system. Food and energy costs are the number 1 and 2 costs for people for household spending. Nothing else takes place of that. Energy is forever. You will always have a utility bill. It is never paid off. It is forever. Food will never be paid off because you have to eat for as long as you live. You will always be eating. You will always be needing and using energy in one form or another. We have often written about and talked about this forever in the financial community. Books have been written about it. Papers have been published. We don't need to go back down that road now, do we? The relationship between these things is not merely correlation. It's causal. All right? When interest rates fall, it lowers the cost of borrowing. All right? That's interest rates 101. But at any given moment, there are many businesses that are considering borrowing money to expand or borrowing money to buy equipment to replace labor. Like they're doing right now. Everyone's buying artificial intelligence and robots to replace the human capital. But at the current rate of interest, it doesn't work. What happens when the interest rate drops? Their business case then becomes sound, so they borrow to increase production. This puts downward pressure on prices. Think of what happens if the supply of hamburgers increases while demand remains the same. Well, the price of a hamburger will drop because they got to move that product. Falling interest rates, on the other hand, has been the trend since 1981. But prior to that, we had rising rates. During the period of rising rates, producers who planned to borrow money to replace worn-out capital equipment found that it didn't work at the new higher rates. However, what did work and worked well indeed was to borrow to buy raw materials and to borrow to finance work in progress, a buffer of partially completed goods in between each step of the manufacturing process. Now, in a period of rising rates and prices, notice how I said rising rates and rising prices together, the longer it takes between when a company buys the ingredients until it sells the finished goods, the more profit it makes. Okay? Thus, they have incentive to borrow more to carry more materials in their warehouses. This definitely does not describe the present environment, now does it? Today, the monetary forces are pushing prices down. However, there are 3 monetary forces that push prices up. Those are regulatory, fiscal, and social. You can't get around reality. That's the problem that we got here. It's about reality. How about, for example, when the government forces gasoline companies to add ethanol or MBTE? These additives push up the cost of petrol. All right. Gas is a low margin commodity, and the increase in the cost per unit causes an increase in the price to the consumer. Now, useless ingredients are being mandated all across the economy. Supply chain tracking, bathrooms compliant with the Americans for Disabilities Act, calorie labels on every item on restaurant menus, minimum wage and other labor laws such as the forced hiring of extra workers, up-teen airbags and automobiles, etc., etc. Now, some of these things may be good and sound good on paper and might have been chosen by free actors in a free market, though not in a rigid, unthinking, inexpensive ways forced by regulators market. However, the point remains. These are costs that do nothing for consumers. Most people don't even know about them. They just say, wow, the price of gas just went up. That's all they're thinking about. All the particulars means nothing. Now, fiscal policy works similarly. It adds costs and hence pushes up prices, but few people are aware of it. Speaking of gasoline, we observed a gas hike in California a while back. You know, New York and California, the two states that are imploding as we speak. Well, we thought that once people forgot about the tax hike, they would just think of the rising price of gas as part of inflation. No discussion of forces that push up prices would be complete without discussing a deliberate reduction in supply based on social concerns. Take the government's response to the COVID. Looking just at the meat industry alone, forced plant closures reduced supply of meat last year. Since demand for food is quite the way it is, the price had to rise dramatically in order to force the marginal consumer to eat less meat. We realize that the mainstream includes all causes of rising prices in their definition of inflation. However, regardless of the words used, we differentiate these non-monetary forces pushing up prices as opposed to the monetary forces pushing them down. Now, this distinction is important, especially if we want to predict what comes next. This is because a monetary force not only causes prices to move, but the result price move transmits feel back to the monetary force. It's a positive feedback loop. It tends to keep running in the same direction for a long time, like a hamster on a wheel. But by contrast, non-monetary forces are one-time events that cause one-time price adjustments. A 25-cent gas tax causes a 25-cent or 23 or 26-cent, depending on your jurisdiction, price hike. But there's no further motion after that unless the legislator meets again. Yes, some will say, but interest rates have been rising. Ladies and gentlemen, this is where we are. Again, this is the difference between all the talking heads in the mainstream media and reality. A lot of times what they're saying out of their mouths has nothing, and I repeat, nothing to do with reality. It is quite the opposite. We live in an opposite world. All right, so just something to think about. Will it be inflation? Will it be deflation? Excuse me, or some new mixture of both? I'll let you guys decide that. All right, you know what it is. Smash that like button, man. Come to PulseWaveTrading.com. We just added a brand new crypto to the reports, crypto.dot. So if you check your dashboard, it is there. All right, so remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. That simply means take whatever profit you can get from the market and don't give it back by way of turning winning trades into losers. All right, I'm out. Peace.